Hello, everyone, and thank you to another one of Leverage Monkey's analysis of Bitcoin. Um, wasn't planning on doing this particular analysis, but a lot of people that are maybe new are kind of wondering what happened with Bitcoin. Last thing they heard, there was Wyckoff accumulation taking place, and it was textbook, and if this was happening, why what happened, and so I just wanted to do a little video to explain what happened, and what went on. So over here, in particular, here is where the Wyckoff accumulation began. Let me circle it here. So the Wyckoff accumulation started like this, and it came to about here. So this is where the Wyckoff accumulation began. Um, it started to do textbook Wyckoff accumulation. Wyckoff experts were saying this is a Wyckoff accumulation that's taking place. It's textbook, nothing wrong. A few of us started to notice the volume was extremely low. And the whole point of an accumulation is to accumulate. So volume being low was concerning to us. We brought it to the Wyckoff expert attention. They stated that there was no research that volume mattered in Wyckoff. And as you know, volume, bearish divergence when price rises but volume's dropping usually is a warning sign. So everybody continued with the textbook Wyckoff accumulation pattern, which the institutions wanted them to believe. They actually gave us the particular information through a couple people that this was a Wyckoff distribution. So they wanted that to be released, that this was a Wyckoff distribution and that they were going to reaccumulate. So when we got down here and we started showing signs of the Wyckoff accumulation, the textbook structure, because Wyckoff is a structure, it's not a pattern, it's a structure, and the structures can deviate from the schematics in certain aspects, and certain aspects they cannot. They still have to maintain the principles and the characteristics of the structure to become a Wyckoff accumulation. And apparently, the Wyckoff experts say volume is not part of that. A lot of us disagree. The whole point of an accumulation is to accumulate. So if buy volume is extremely low, that's a warning sign. So the Wyckoff accumulation went through, it did the AR, it did everything. It came through the SC, the ST, SC went into phase 2, 3, and even into phase 4. And in phase 4, where it did the spring, it came back up, it did the test, it came to do the second test. The second test did not hold, and it completely fell back down. Everybody said, oh yeah, this is still part of the Wyckoff distribution. It's fine as long as it holds above, 32,200. It'll be fine. It's the second test, and it's just, doing the second test. Well, at this particular point in time right here, where the normal Wyckoff accumulation would start its way back up, it completely collapsed. And when it collapsed, it entered into what I was saying the whole time, is that this was a Wyckoff, this was a redistribution to swing traders. It entered into, when the accumulation collapsed, into a Wyckoff redistribution. And inside the redistribution, we have the Elliott wave corrective triangle here, and the Elliott wave corrective triangle, as you know, completed. And that's where the trouble started. Once this started happening, more coins were being brought to the exchange. The SEC actually brought Tether back into their different talks and other stuff. So this is very strategically all planned out, very coordinated attack. Even someone met with the CEO of Coinbase or something like that, like a week before this happened. I forget exactly who it was, and then China started doing the ban and kicking all the miners out. This is all very, very coordinated. Very. This isn't by accident. This is all by design and created. Elon's tweets actually line up. I'm not saying Elon made any of this happen, but it's very interesting that his tweets perfectly go with a lot of the Wyckoff, where you look at the pattern and you see where his tweets are at the top of a rally, and then it curls over once he tweeted. That was one that I noticed. I don't have it marked on here, but I'm sure if you go back and you date his tweets, you'll be able to see what I was talking about. In Wyckoff, there is what's called a composite operator, the one that is doing the distribution and accumulation. They tend to push the particular asset where they want it to accumulate. And they do this through sometimes with dumping. They do this sometimes with shorting. So when you're bringing a stock or security up or down, you need to have a good position in that stock. And then also about, I'd say 20 to 25% of that position, you're not going to hold as a core. You're going to use it to push the stock around. And you can also use shorting as part of that 20-25%. But really, if they go real lean and they try to be too greedy and have more than a 70-75% position of holding as core, and the other part not as working capital, they run the risk of being overrun by buyers. So it becomes dangerous for them. And in this particular with Bitcoin, with the regulation FUD, the Chinese FUD, the energy FUD, the Tether FUD, the CBDCs coming out, and they're saying, oh yeah, we're not going to need Bitcoin or crypto anymore once the CBDCs come out. They have a little bit of extra advantage to be able to push stuff around. So they maybe can hold a more higher position, core position, when they accumulate and need less working capital, working coins to work with. And also with shorting and derivatives so widely available, they can run it leaner as well, and use media to try to mitigate being overrun by buyers. But back to this Wyckoff redistribution. It pretty much started when the accumulation deviated from the structure. The Wyckoff redistribution and Elliott corrective wave pattern started immediately right after the deviation. And so at this point right now, we look to be doing the second LPSY before the breakdown. Not saying that will or will not happen. It's a possibility. We did, as I mentioned in the last video, we did not get the rally that we normally get here to go back up to the 61.8 fib level, where we rally back up and touch the 61.8 fib level. we usually hang out there about 2 weeks and then we come back down. We did not get that. And understandably, this Wyckoff is institutional manipulation and coordination. So it's quite possible that that's the reason why we didn't get it. Bitcoin and crypto market cap was reaching $2 trillion, and that was getting bigger than they wanted control over. They were starting to lose control. If it gets bigger than a market cap of 2 trillion, they felt that they would lose control. That's why pretty much they're bringing it back down. If you've noticed, BlackRock and all the institutions have pretty much applied to buy Bitcoin, some with upwards of 25% in their fund, and their wealth clients to buy, but yet none of them are buying. They're playing with $500,000 in derivatives, which is very concerning. The whales that you see here are small whales. Kathy Wood Ark is buying here. Michael Saylors is buying here. The big whales, with their master plan, don't really talk to the little whales. The big hand doesn't talk to the little hand. And also, these are entry level positions. So in the past, Bitcoin has held the 161.8 fib level. So with Kathy adding to the ARK funds here as entry positions in Bitcoin, that's understandable for her to open entries here and then dollar cost average down to bring down her cost basis. So I don't blame her. Michael Saylors, on the other hand, his cost basis is quite low. He started in at 10K. I don't see us going below 16K. His cost basis now is about at 25, which is probably going to be not bad in the next couple of years, a $25,000 cost basis. So he has a low cost basis, pretty low cost basis, and all his debt that he's issuing and stuff like that, he can't be squeezed. And also all the debt that he's issuing is pretty cheap. He's doing basically 0% borrowing it, and so he is right in the aspect that the Fed printing, you're going to want to own leveraged assets, and the question becomes what are leveraged assets. Bitcoin and Ethereum, I believe, are going to be pretty important to the financial industry later on, and with smart contracts and stuff like that, and the base layer of Bitcoin being used as a store of value. So back to this Wyckoff redistribution. It pretty much started when the Wyckoff pattern failed, and it failed due to pretty much not accumulating. You have to have buy volume in a Wyckoff accumulation. The experts that run schools and stuff like that are telling people that volume doesn't matter, or that there's no studies that the volume matters. I disagree with you, and looks like Bitcoin's gonna prove me right and you wrong. But they make their money on marketing and getting people to go to the school, so it doesn't matter if they're wrong. I have nothing to gain by being right or wrong. I'm just trying to be as honest as possible and share my knowledge with you. I'm not a Wyckoff expert, a Wyckoфfian. I'm just a trader that's been trading for a while, and I notice things that others miss because they're biased. So this could and could not play out. I don't know, but I'm just showing you what I've observed, the structure, what happened to the Wyckoff accumulation, pretty much immediately deviating from the structure that this was born. And that's pretty much where we're at today. I can't really think of much more I want to say. I'll update you guys if I come up with anything else, but that's pretty much the gist of it. Thank you for listening and watching. Have a great weekend, and look forward to speaking to you guys again. if I think of any other important information that you guys should have. Oh, one last thing: the traditional investment order that I normally talk about in Twitter, and some people have got it. It was mostly in personal conversation. So the traditional investment order is always institutions in first, then they get their wealth clients in first, and then they have the media hype after they both have accumulated. The media hypes it up. They distribute to the retail investor, which is me and you, small mom and pops investors. Then they have their wealth clients distribute, then they short, and then they start with the negative news and the markdown and bringing it back down so they can reaccumulate. That's the traditional investment order. With Bitcoin, there's a lot of retail in there. So there's two ways to get retail out. First one is they shake them out. That usually gets a good majority of them out. But if that doesn't work, it's wait them out. So sideways action, just doing chop sideways for long periods of time. And stealth, they'll be stealth accumulating during that time as the retail capitulate and leave due to boredom. Traders that need to make their 2% a day or whatever, they'll just give up if volatility is real low, because volatility with trading is your friend. Doesn't matter if it goes up or down. You just need movement to be able to make money. And so if they chop sideways and drop the volatility, those traders will leave. So shake them out, wait them out. That's pretty much the way that they get them out. And in my previous analysis, I talked about the liquidity voids. Uh, that's their next part of getting more people out and capitulating. That's probably what they have planned for next. But that's about it. Not trying to be biased, just showing you the possibilities of what could happen. We could rally here. This is where it could be a Wyckoff accumulation, and we could rally here up to 50,000. They distribute there, and then they finally bring it down and fill those voids later on. That is another scenario. It's quite possible. So, not trying to be biased, just showing you opening your eyes to what is taking place and what the possibilities are. Do your own research. Nothing that I say is financial advice. Not a financial advisor. But that's it. Have a great weekend. Thank you. Hope you guys enjoyed. Bye.